The only time when gold was expensive was the 2011 all-time high, 1921. And now we have seen so much debt creation and balance sheets on the Federal Reserve going up so much during the last 10, 15 years. And that makes a lot of room for gold because, normally gold doesn't have a price. Gold is gold, and it's the fiat currency that loses value. And of course, the more credit or units of the fiat value you create, the less they are worth. And we are creating a lot of fiat currencies now, so that's the reason for gold to go up. We don't really like outlooks, but we set a 20% for the whole year and 24.75 at the end of the year, and now it looks like not a very big target. And even JP Morgan came out here in March to say 2,500, so I think we can go a lot higher this year.
Amidst fluctuations in the global market, gold prices have been subject to various influences, prompting shifts in investor sentiment and strategic outlooks. EricStrand, founder and portfolio manager of AuAg Funds, initially projected a 20% increase in gold prices throughout the year, aiming for a year-end target of $2,475, aligning with JP Morgan's estimate of $2,500. These forecasts suggest the potential for further upward movement in gold prices. However, recent trends indicate a shift in momentum. The price of gold has confirmed its breakdown below a rising support line, signaling a potential downturn. This, coupled with developments in the forex market, suggests a bearish trajectory for gold in the near term. Strand attributes gold's attractiveness to its status as a store of value, particularly amidst significant fiat currency creation and central bank balance sheet expansions over the past decade. As fiat currencies depreciate due to inflation and currency debasement, gold emerges as a preferred asset for wealth preservation. While reports indicate China's continued accumulation of gold reserves, with 18 consecutive months of expansion, the pace of buying has slowed, reflecting changing dynamics in global economic conditions. Meanwhile, gold steadied on Wednesday as investors awaited U.S. data for clues on potential Fed rate cuts. The slight uptick in the dollar limited any significant upside for gold prices. Strand notes the potential resistance from central banks to lower interest rates initially despite systemic economic challenges such as U.S. commercial real estate troubles. However, the delay in interest rate cuts poses a challenge for President Biden, as experts suggest it could impact economic output and exacerbate the financial strain of inflation, potentially influencing his re-election prospects. Join us as we delve into EricStrand's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
We don't really like outlooks, but we set a 20% for the whole year and 24.75 at the end of the year, and now it looks like not a very big target. And even JP Morgan came out here in March to say 2,500, so I think we can go a lot higher this year. Of course, now we are in the situation, a lot of shorts on the COMEX. They want to get the prices down, and if they can push the prices more down below the 200 days moving average, prices will go even more down. So it's a very interesting situation. But in the basics, I think it's going up for the year. Well, the shorts, they are playing the game. They're always going shorts when the price goes up, and then they want to buy back the shorts on lower prices. And they've been doing that for a lot of years now, unfortunately. COMEX has become kind of casino for big banks. It was made for producers to hedge their production, but the producers, they don't hedge anymore, like farmers or miners should do, or that was the purpose of the COMEX, of the commodity exchange. Now it's a big bank casino, and some players, they put on big short positions, and unfortunately for them, the prices went up with the central banks buying, with the Asian investors buying a lot, and then they have big unrealized losses. It was up to $20 billion, come down a little bit now as gold has come off a little bit of the top, and of course they are interested to get the prices lower so they can buy back their shorts. For them, hopefully with a profit, but let's see if it works. Yeah, and of course the central banks we have this situation, the global situation, and the US doing its things with the dollar. They're weaponizing the dollar, and also the talks about confiscating the Russian assets. We can discuss it, if it's correct or not, but it creates a situation like if China are planning something, will they hold any US assets before they do the thing or whatever? They will de-invest in the dollar, and they probably rather hold gold. So I think that's a reason for a lot of BRICS countries to hold gold instead of US dollars. The only time when gold was expensive was the 2011 all-time high, 1921. And now we have seen so much debt creation and balance sheets on the Federal Reserve going up so much during the last 10, 15 years. And that makes a lot of room for gold because, I mean, normally gold doesn't have a price. Gold is gold, and it's the fiat currency that loses value. And of course, the more credit or units of the fiat value you create, the less they are worth. And we are creating a lot of fiat currencies now, so that's the reason for gold to go up, and I think there's a lot of room to go. They will not lower rates because they have control of inflation, but normally they lower rates because there's a problem in the system, and they're always late. And they want to be late because then they have the reason to lower the rates, because they have to lower the rates because the system is breaking down. And when you see commercial real estate in the US, it's not really good, and one day will have so much trouble, so they will have to start to lower rates. So it's not because they want or can lower rates. That's not the reason why they will lower rates, because they will lower rates because they have to lower rates, and that's a big difference between that they having control of inflation, and they will not have. So, and one day they have to give up on something, and they have to give up on this what they like to think is the fight of inflation. I mean, they created the inflation with money printing, so now they are fighting their own inflation, and normally I think they will give up on it because no politicians can survive big recessions today, so the whole system needs more money.
Strand highlights that while gold prices surged due to monetary inflation, miners have struggled to generate significant profits due to high production costs. However, as costs stabilize and gold prices continue to rise, miners are expected to see improved profit margins, potentially increasing their stock prices. Moreover, historical data indicates that gold stocks tend to outperform gold itself during periods of strong trending moves in the gold market. This phenomenon is observed during and after major gold price breakouts and significant rebounds, such as those seen after gold price lows in October 2008 and March 2020. For instance, notable cyclical bull markets in gold include the August 2018 to August 2020 period, which included a breakout through $1,375 in July 2019. Similarly, the October 2008 to April 2011 bull market saw a breakout through $1,000 in September 2009. Strand sees potential for triple-digit returns in gold mining equities this year, building on past double-digit gains. With mining stocks known for rapid price movements during rallies, they present an attractive opportunity for investors amid a potential surge in gold prices. Let's get back to the interview.
Now we have at least started to see, I mean, March and April was really good for the miners and our funds, but there is a delay, and I think it's natural. Normally it's always like that. Sometimes the miners go before, or sometimes they are delayed, and I think now we had the costs, with the inflation cost for the miners to mine the gold, and the gold price went up because of the monetary inflation, so they didn't make much more money. And but now, I mean, the costs have stabilized for the miners, and gold continues to go up. And actually the leverage, the profit leverage the margin expansion will be much stronger now because of the higher prices to produce. And I think we will see that effect of the miners, and then they will really run. And I mean, they run fast. We see many periods when in 6, 7, 8 months they run 120%, so it goes fast. So there will be a catching up. And that's actually a good opportunity for investors. So if they miss the gold race, they can still make a lot of money on the miners now. But we are really waiting for the year when we have a triple digits gains. We started our funds 2019, so we have had only double digit gains some years, and sometimes it was a minus also. But we will get the triple digit years as well. And actually, after the first 2 months, we were one of the worst funds of all funds. And now we are one of the best funds already after 4 months. So it can be this year. It goes fast. Miners move really fast when they start to move. Normally, I mean, I like to be, it's good to have the company that is being sold to another company, get a premium. But basically, I'm a bit sad that we get less and less companies. I want to have a lot of companies. I want to have companies to choose from. And it gets less and less, and I don't like that. Yeah, it is. But of course, we are a larger fund, so we trade only on the New York Exchange and the TSX. So then there are not so many to choose from. Also, what is important when the M&A, I mean, it's good for the business. The companies they have the cash to do it, so that's a good sign. But we don't mine more gold or silver because it's an acquisition or a merger. I think that would be good for the commodity price. I mean, they don't put money to exploration. And that's hard for the explorers because they don't get bought at this moment. But also there are no more developments, no new gold or new silver coming to the market. So, and that will actually push the prices for the commodity higher, and that will be good for them, for the big miners. But it doesn't give us more gold or silver in the market. But first of all, I think we have to notice that there has been a big change from the 2011 era when they did too much expansion, too much growth, and they spent too much money. And shareholders were not happy with that, and all owners had to pay for that. Now they are doing the opposite. They are keeping the cash, or they are buying already developing rather big companies, and they have higher dividends, rather high dividends. They are starting doing buybacks. They have lowered the debt, which is, I mean, it's great for the companies. They look good, but of course they don't grow as much. So it's an interesting situation, and they are very unsecure due to geopolitical reasons to start a new mine. Even if you have something there, you start it. It takes a lot of time, costs a lot of money, and then you don't know the political situation. So I think it will be different this time. If there's no exploration, no growth, there will be less gold and silver in the market, and the price of gold and silver will go up, and then the big ones, they will make money on that. So I don't know, I think that's the new trend for the moment. One day it will maybe start to change if big one finds some good explorers that really have the gold and silver they think they have. That may change, and the competition between the leaders will be fierce. So I think that can change things over time, but at the moment they are focusing on being share owner friendly to existing share owners, good or bad, but I think that's the play right now.
From the initial projections of gold price increases to the recent shifts in momentum and the potential implications for miners and investors, senior Bloomberg commodity strategist Mike McGlone predicts in the latest update that the next leg up for gold prices is $3,000 an ounce. Moreover, the historical data highlighting the outperformance of gold mining equities during significant market moves underscores the potential for lucrative returns in this sector. How will you position your portfolio to capitalize on the evolving dynamics of the gold market? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.